Welcome to the Real Estate Social Club. We've got here Joshua, who is a regional director at a tax specialty firm. Welcome, Joshua. How's it going?
It's going great. Thank you. Thank you. Hello, everybody.
Hi. So, what is it that you do? Because your title is quite interesting.
Yeah, no, that's a great question, and I get that often. So we essentially, people with a similar title and at work at specialty firms, we assist your typical CPA or businesses as a whole. We help them to find and embrace those areas of tax that help them to get the most out of their situation, whether it be, through a specific tax credit or maybe a specific strategy. And a lot of times we pair with CPAs to help them also have access to these various strategies. And this ultimately saves businesses and, thousands of people money every year versus, having to pay this to the government because they qualified for money they didn't have to spend.
No, I love what saving money. That's great. And, I think that's super important in these times right now, being able to have that knowledge and insight, especially operating a business and, for people that have their personal taxes, if there may be a small mom and pop type of business. Having a real estate portfolio, I think that's super critical and essential. Tell us a little more. I want to know what you've been up to and how'd you get into this?
Yeah, no, that's a great question because I think most people that are in my seat or that work at a specialty firm, they have a really odd path there because a lot of people don't know what it is. And I gave you a little explanation on the front end there, but kind of more on the back end. Essentially, what you can think of what I do is I am the specialty area of tax programs that some people qualify for, and some without those activities they wouldn't. But essentially, we work with the CPA who does your general taxes. They are, I guess, analogously, we could say they would be the equivalent of your annual doctor that you visit, so your primary care physician. And we would be, let's say, we're a heart doctor in a specific area of tax. So unless you have a heart condition, you wouldn't come visit, your heart doctor. And we're very similar in that respect. So my area, it spans from research and development, cost segregation, which that helps and that will apply here. And we'll talk a little more about that. But we also do the energy incentives. So people that invest in energy or the environmental incentives, such as wind, solar, and a few others. But those would be the really applicable areas more likely to the audience that's listening here today. But these strategies are integral and they can be the difference in some of the tax moves that you make and some of the money that you spend and the difference in that staying in your pocket versus going to Uncle Sam, I guess you could say.
Mm-hmm.
Yeah. And I think that the thing that really makes our area a difficult one is that a lot of people assume, and back to my analogy, that the CPA is able to handle all of that. So, hey, I took my taxes to my CPA. I
Mm-hmm.
purchased this property. I made these big moves this year. My CPA will know what to do with that. And that's partially true. And it's not a knock on CPAs by any means. It's
Right,
it's
all right,
the
all right. Because
yeah.
you might have some CPAs being like, "What is that statement?"
Okay, so, again, not a knock on CPAs by any means, but what I do think is that CPAs sometimes don't have the specialists in their arsenal, and maybe it's not the resourceful information that they have access to, or, maybe people like me haven't touched them yet. So they know these areas exist, but they might not have the resources or the tools to be able to actually navigate that. Give you an example here. And the two that I really think stick out in terms of tax strategies, especially to the audience, is one being cost segregation and two being some of the environmental and energy incentives. And some of the other ones do apply too. And I'll also mention 179D and 45L. But those three programs specifically, 45L and 179D, kind of go together, but we'll talk about them mostly. So starting with cost segregation essentially takes your taxes and it allows you to take a deduction. So you're removing a portion of your taxable income. That means you're taking your tax bill and you're essentially shrinking it on the front end and then what you're able to be taxed on gets a little smaller on the back end. And this is a strategy that is for, property specifically. So you'll take, let's say that you purchase a really large building and it's worth, for easy math here, we'll do $1 million. It's $1 million
Okay.
property that you buy, and you are going to take the depreciation of that asset. You can take it over 39 years typically. So you're taking little chunks of that $1 million, and you're putting that on your taxes, and you're reducing your income, and it's helping. Now, what CPAs typically don't have the resources for, because some of this involves having an engineer, and which firms like mine are prepared to handle this. But what happens is there's some assets. So let's say you do some renovations, you're a doctor's office, you buy various equipment, you make small changes to your facility. Well, you can take those small changes and you can also depreciate them. Well, what cost segregation does is it allows you to take all of those and take the deduction for it in the first year up front. So you are essentially having access to 39 years in some cases, or 5, 15 years of depreciation, depending on what it is. You are taking all of that and saying, I don't want to take it in small chunks. I want the big one. I have a big income, a larger income this year. So it makes sense to reduce that down. And sometimes I've had people go from a couple $1,000, or way more than that, thousands of dollars tax bill in a tax bill that has decreased down to hundreds. So these strategies are really integral, and they're built in order to incentivize the public to make moves that the government has deemed essential for society to move forward. So, that's a very, very high level explanation, but I think that, I can tap into each of them as we go along. But I think where it's really important to start is the changes that came with the One Big Beautiful Bill recently.
Mm-hmm. Mm-hmm.
And yeah, there's been a lot happening, and I don't know about you, May, but have you heard anything about all the
Yeah.
stuff happening?
Yeah. Yeah, there's lots of stuff. There's a lot of noise. I don't know. Every time I wake up and I'm just like, wow, there's so many things going on. I know, you mentioned something about depreciation. Can you just talk through what depreciation looks like to an audience that has never heard this term?
Yeah, that's a great question. And I think that, and by all means, pause me if at any point I start sounding a little too tax industry. Because, after, yeah, after you get it drilled in your head enough, you start to forget that everybody isn't. So, by all means, if there's ever something, let me know. But depreciation, really what it is it's a strategy that was built and incorporated into the tax code. So, you'll hear us say IRC. Your CPA will definitely know what that is. But it's the tax code, and really, it's when you have an asset, you're able to take little chunks of it over time. So the point is that it has a life that you're going to hopefully have it for the entire time, but it has an expected life, and various assets will fall into different categories. So, like a building will fall typically into that 39-year range, where some things that have a shorter life, where you're expected to replace them more sporadically, they'll have like a shorter. So, usually it's like 5 years, 15 years, 27 years, but it will depend on what it is to see how the calculation automatically will break it down. Let's give an analogy to kind of, make it make sense to somebody that probably doesn't see the numbers for what's happening here. But let's say that you buy one big large thing. We'll say that you're buying a supermarket. You buy this supermarket, and you're going to take that supermarket, you're going to break it down for 39 years. You're going to get little chunks because, in the 40th year, that supermarket might be expected to have been replaced. So we're taking little tiny chunks of that and taking it off our tax. So you're going to take, 39, we'll say it was a $39,000 building. We're going to take 1,000 each year. It's divided by 39. Well, then there's all these little assets inside of it. So you've got some electrical work. You get a new parking lot. You went and paved a new parking lot, and
Mm-hmm.
I'd have to look at the schedule, so don't quote me on some of these, but let's say that the parking lot, it's depreciated over 15 years. So now you have 39 years versus one thing that you own on this property that is 15 years. How do you do all of that? And the CPA would be able to probably break down those small pieces, but when you start getting into the nuances, such as like light fixtures, or maybe you got a new desk and you put it up, and you got some new electrical wiring ran to it. All of those things will have a different life, and they'll be
Mm-hmm.
depreciated differently. So the amount that you can take off of your taxes will be very nuanced and very distinct. So what cost segregation and depreciation does is it allows you, well, cost segregation specifically, to take all of those ones that you normally would have had divided up and take them and you say,
Mm-hmm.
I'm going to take all of that now. And that's what the one big beautiful bill actually made really expansive. So we'll go with that on
What
that
was
next.
different? What is the change? Did that not
Yeah.
exist before? So the depreciation, it sounds like you can do that, for real estate, maybe 39 years, and it's all kind of dependent on what that asset is. Now, my question is, what is the difference of this cost segregation? Did it exist at all? Was it, the lifespan, maybe 5 years? What is this? Tell us. Tell me now.
Yeah. So tell me
Just
that.
kidding.
Well, we'll wait till we see I'll walk through a couple of cases that we've seen too, so that way you can see what it is as a strategy later. But yeah, so cost segregation has been a strategy that's been used, and even for individual taxpayers that don't own a
Hmm.
business, there's still an element of that. So depreciating assets. So sometimes you'll depreciate things like, I guess we could say, like if you were renting your home, you can depreciate parts of it, you
Hmm.
can depreciate the whole thing, and it will just really depend on how the property is used. But this is something that's been a tax strategy for quite a while now. Before the one big beautiful bill, what happened is you would take all of those assets, you'd put them into their respective category, and then you would put them in a sum, and essentially you would take that and you would be able to take up to 100%, and then it stepped down each year, uh down to, like, so if you wait in the year that you place it in service, you wait till the next year to do this depreciation strategy. The first year was 100%, and then if you waited, then it was 80%, and then if you waited 2 years, it was 60%, and then 40%, so forth. Well, now what's happened is, before it was 40% is what you were able to uh, reduce and depreciate, but now the big beautiful bill has made it so you can take 100% in that first year. So you're essentially getting 60% more. So let's say you have that 39, well, the building won't change, but let's say you have some assets and you ultimately determine that over the course of all of these assets that in their life, you're going to be able to get $100,000 in a deduction. Well, before you would have only gotten 40,000 of that to reduce in that first year. Now you would be able to take that full 100,000. So you're going from 40,000 to an additional 60,000 of depreciation that you take off of your income, and then it essentially produces a new tax bill that is much prettier.
Oh yeah, I'm sure. That is actually very, very exciting. And it's for people to learn and to know this strategy. I think it is very beneficial, and you've got some valuable information that a lot of people probably don't know about, and that must feel good. Now we just need to get it
Yeah.
out to them so that they can understand what they're missing out on and how they can utilize this in their financial situation.
Yeah, no, and I think that that's the big thing that I see is, a lot of times I'm speaking with people and it's maybe the first time they've heard these strategies, because, as I said earlier, they might talk to their CPA and they're like, "Look, I've purchased all this stuff and my CPA has never brought up a cost segregation study," is what we would call it. They were never had this
Hmm.
team of people come and look at their property, look at the assets, look at the blueprints, and see what individual items could potentially be, depreciated differently. So they might say,
Hmm.
is this something we can do, and they wouldn't have an avenue. So the CPA might say, well, I don't have the ability to come, I have thousands of tax returns to do right now. I don't have the time to come and look to see if you put a new outlet in the right spot. So yeah, typically it fades away. So it is great to know these strategies exist, but I think finding the right places for them to apply, and specifically in the real estate world, there is a plethora of opportunities for people to really start to consider these strategies. And a lot of people don't know what they are until it's more reactive. So they'll buy something and then they'll find out because somebody will come to them and say, "All right, I see that you just invested, $400,000 into a new property you're building from the ground up, and you're going to use it for business." So they now have somebody reacting to that purchase versus
Hmm.
them having built a tax strategy and plan around how to do it. And I've seen people get their tax bill to nearly zero because they planned. So yeah, very helpful.
Yeah, planning is essential and it's super important. And, it's that whole reactive versus proactive. We all know that battle viral, and it's quite a big one. What else can you tell us about this big beautiful bill?
Yeah, no, that's another great question. And I think everybody's still scratching their head. We're still trying to figure out exactly how it all happened. But really, so in the tax credits and incentives world, there was a bunch of changes that people were wanting to happen, and they were wanting to see with this, the new administration. Take it or leave it, take your, whatever, whether you like it or not. There was some hopes from both sides that things would change in X way, and one, the biggest, was the research and development tax credit. So if you're a business owner that invests in research, or maybe you have a
Mm,
team of people that you're using to help build you a new property, that's definitely something to look into. And
mhm,
that was also changed. And it probably wouldn't apply so much to the audience here, but if you have some architects, some engineers, or you're working with any of them, it might be worth mentioning, hey, now's a great time to take that credit, because they made a big change to it, where before you had to take it over 5 years, and now you can take it in the first year. So that's a big change. And then, of course, going back to cost segregation, that is a really great thing that's happened for, especially, I would say, everybody from investors, commercial property developers. It's endless. If you are purchasing an asset, talk about cost segregation. If you are making a big purchase like that, talk about it. And I've seen it from, everywhere can pretty much take advantage of that. And I've seen it from RV parks. I see it a lot in really
mhm.
large buildings that are being renovated, doctors' offices. I see it in supermarkets, like I said earlier, my other example.
Uh-huh.
But that's a really strong strategy that saw that change. And the other, now these ones are a little bit more unfortunate, which was why I didn't want to lose any enthusiasm while talking about it. But the importance of, I guess, this podcast is bringing them into the limelight to say, hey, if you are going to talk about tax strategies, these are the ones to start with, because they are advantageous to people purchasing properties on the individual level, and what you can do with it to make sure you're getting the most. And that is the energy incentives. Well, the environmental energy incentives. This encapsulates 179D, 45L. You'll hear that tossed around in the real estate environment. And then, of course,
Mhm.
some of things like the residential solar, as well as some of the commercial solar incentives and various programs have taken a big hit, but a lot of them are on their sunset. So that means that after June 30th of 2026, you're not going to be able to claim those any longer if you do one of those activities after that date. So that's really the big change there, which is an unfortunate one. But I think that if you are renovating a property, or you're planning on making some sort of value add to where you get the most, I would recommend doing those moves, or
Doing
at
that
least
now
talking to somebody about
before.
doing it now, because you don't want to wait and then lose the opportunity. And especially with solar, the residential solar tax credit that you would get, I believe it was 30% back from the money that you invested into that. You would be able to get 30%. You will actually lose the option to do that if you don't have the project completed by the end of this year. You definitely, if there's still time and you were thinking about solar right now, you can get a large discount on it, I guess you could call it, and if you are to do that and make the moves to get it done before. So that could be also a value add to any property.
All right, you're gonna have to tell me,
You're fine.
Joshua. I know that there's some new changes happening with the big, beautiful bill, and there's a deadline at the end of the year. What is it that people need to take advantage of before it ends?
Yeah, no, I think that's a really important question that people should be asking, because planning is going to be everything now. Because you've only got a few more months to make the moves that you need to make in order to take advantage of these various credits. So, like I was saying earlier, with the energy and environmental incentives, the residential clean energy credit, which means that homeowners, they of course can claim a 30% tax on eligible costs for solar panels. And this also includes the materials and various items that go into that project. But if you don't have that installed or paid for by December 31st of this year, then you are not going to be able to get that 30%. That will be gone. So if you start on January 1 and you're like, hey, I'm paying for this whole thing, I'm getting it completed, unfortunately you won't get the credit. So definitely, if your plan includes that, I mean, include that in your plan. That's integral for residential homeowners or buyers, even. Yeah, so I think that, something else that's worth mentioning is the 45L and D portion of tax law. Currently, people are, as I was talking about the other energy incentives and environmental incentives, these were all started under the IRA, which is the Inflation Reduction Act. They have taken the biggest hit here. And I think that if you are into making these types of changes where you're doing some environmental or energy efficient upgrades, definitely talk to
Hmm.
somebody about doing them sooner than later, because there are tax credits and incentives out there that you can utilize to help yourself get some of that money back, or in some cases pay for it. And let's start with 179D. If you're a commercial property, or you're doing anything to a commercial property, it's worth talking about it if you're thinking about a new HVAC system, upgrading some of your lighting, or you're doing any renovation. You should definitely bring up 179D, because if you don't have those in place, those plans in place, and you're making active moves on it by June of next year, you could be missing out on a lot of money, which in most cases it's $5 per square foot. And I think that that's a good threshold for you to kind of do the calculations. Take your property and the square footage and multiply that by $5. That's the amount of money, depending on what you derive there. That's how much you could be taking off your tax return, and you're going to lose that after that time. The most important one too, I think, for anybody that's buying or plans to build and do anything to an individual home, and you're making some energy efficient upgrades. So let's say it's single family or multifamily, up to 3 stories. You can get up to $5,000 currently for each of those properties if you make the various upgrades that are required. There are some strict standards, but a lot of people that are actually doing the work will be aware of what those are. And you need to stick to the Energy Star standard for the most part, and then the Zero Energy Ready Home standard for the full credit. But if I don't want to get too nuanced and make people lose lose interest in it, because it's way more accessible than I think people actually realize. But you definitely want to pull in somebody, so ask those questions whenever you're doing any renovations or flipping, or if you are somebody that actually does that, bring that up to your CPA, or if you do have a specialist that's like
Or they
some,
could reach out to you.
they could reach out to me. Yes.
Right. So, I love all of this information. It's been super useful. I think we should maybe one day have another session, just maybe drawing it out on a whiteboard or having it on a screen, some visuals. I find visuals would be really helpful to kind of see what that looks like by using these tax incentives and having these tax strategies. So, I'm going to come find you and ask you to come hang out with me again.
Anytime, anytime. It's always great, and I really appreciate you having me on here today. I think for the message that needs to be heard, it's to, if you think that there's any opportunity for the activity that you're doing, or you're doing anything different than the year before. It could be buying a property, it could be building one, it could be selling one, it could be any of those activities. If you do any of that, bring any of those points I brought up today, because it could be the difference in you getting thousands and thousands of dollars. And I'll have May post my information. So if anybody has any questions at all, you can always reach me through that email, and I'll be happy to answer them thoroughly. So I'll gladly be a resource. And I, again, can't thank you enough for having me on here, and I'm happy to join again.
Appreciate you, Joshua. I will be posting some of your information below. So thanks so much for joining us. If you are interested and you like the content, click subscribe, comment, share it with people that you know. Appreciate it. Until next time. Bye.
Bye, everybody.